Welcome to MSCI Perspectives. I'm your host, Adam Bass, and today is October 9th, 2025. While markets have recovered somewhat from last quarter's turbulence, challenges remain. Whether it's questions around continued U.S. dominance, the real impact of AI, or the rise of private assets. To find out what's really on investors' minds, Chief Research and Development Officer Ashley Lester sat down with MSCI's Michelle Shanley. She's the Global Head of Strategic and Key Accounts. Here's that conversation.
Hello, listeners, wherever you may be, and welcome to our quarterly investment trends update. I'm Ashley Lester, the Chief Research and Development Officer at MSCI. This quarter, I'm joined by my good friend and one of our most senior client officers, whose special mission is to know and serve our largest clients around the globe, Michelle Shanley. Michelle, welcome to the podcast. Perhaps you could introduce yourself to our listeners.
Great. Thank you, Ashley. So happy to be here. Again, Michelle Shanley, and I lead our global strategic account effort at MSCI. And this is an effort where we engage with our largest and most strategic clients around problems they're trying to solve, opportunities they're trying to monetize, and how MSCI solution can fit into that equation.
Great. So, Michelle, our task today is to bring our listeners up to date with the most important trends that we saw in the world of finance over the last 3 months. I'd say I was thinking about how to describe these 3 months. I think maybe they lacked the raw drama of the second quarter when we had Liberation Day and a tariff-induced meltdown in markets, and then that very fast, very rapid bounce back. But they've had their own peculiar drama, I think, to them, and maybe their own peculiar underlying logic. Here's a pop quiz for you. Can you guess the world's best performing major asset class last quarter, or alternatively, the best performing stock market?
I would guess the best performing stock market would be the U.S. and the asset class, perhaps large cap equities.
Here we go. Good guesses, but not quite there. So over the last 3 months to the end of last week, October 2, actually the top performing asset class in the world was gold. It was up over 13% in the quarter, and it's up 40% this year. And the best performing stock market was, drumroll, China. It was up more than 22% last quarter and 45% this year. So not bad for an uninvestable asset class. The US recovery in Q3 was a bit over 8%. So strange times. Gold used to be thought of as kind of a classic risk-off asset, whereas last quarter things kind of bounced around. But the other big performer obviously is China, which was definitely not traditionally a risk-off asset class. So, what are your clients talking about in the middle of these very unusual times?
I think clients in general are struggling with what to do about U.S. exposure. Obviously, there is risk around U.S. institutions, but nobody wants to give up the exposure to technology and innovation that obviously has been led by our Mag 7 and related stocks. I think that's a big focus for institutions around the globe. Obviously, private assets is another big theme that I think we'll be talking about today. And of course, AI, which obviously feeds into the first topic.
That's definitely some big themes. I agree that there's this big sort of there's this divide. I wonder how your clients, especially in the States, are thinking about it. In Europe and Asia Pacific, there's definitely a sense of a willingness to investigate whether it's still appropriate to have 70% of your growth assets in the US. And so kind of a general openness to alternative arrangements, but at the same time, very little movement actually away from the US, really, because as you've noted, in some sense, developing markets aside, and maybe we'll come back to those, there's a little bit of a sense of there is no alternative because of this big technological supremacy that the US seems to have. Inside the US, is there that same sense of unease with having 70% of assets in the US? Oh.
I think there's a little less unease, and some of that is, artificially held up by certain positions of institutions in the U.S. But we have seen some tactical reallocation to developed non-U.S. market. So diversifying a little bit, I think, around the edges. Obviously, there's been sensitivity around China and perhaps missing out on some of that upside that you noted earlier. But I'd say in Canada, we see asset owners really looking at China opportunistically and looking at what it represents, given some of the asset flows earlier in the year outside of that market. So I think a lot of people, the U.S. institutions are not doing a whole lot, but rebalancing around the edges. I think we also see them looking at their, private asset allocations and valuations in PE and looking throughout the private asset spectrum around allocations. So,
Yeah, it's pretty interesting, right? So in that quarter, right, I mentioned that the US was up about 8%. That was a little better than Europe, which was up a bit under 6%, a little worse than emerging markets, 11%. But if you go sort of underneath the hood, um, US mega caps were up 12, so they handily beat even emerging markets, whereas the rest of the US sort of main part of the index was only 3.5% up. So that was way behind even Europe. And so I feel like the flows that people are driving into the States are very much expressing this view that what exposure do they want to US assets? They want the exposure that they can't get anywhere else, which is basically these mega caps. Are your clients expressing any concerns about valuation, though? I mean, the valuation on this stuff is super extreme. So the mega cap price earnings ratio is sitting at about 33 compared to about 24 for the world as a whole, and that's including the States.
yes, absolutely. I think that that is a concern, and maybe why we're seeing some risk budgets increasing and more greater emphasis on liquidity management in order to be in a position to take action on the heels of those valuations. Um, So I would note that. I would also note that, we had a very timely blog posted this morning, right, which I can let you elaborate on the price of U.S. exceptionalism, which I thought was, quite timely.
Oh, well, thank you, Michelle, for that opening to discuss some of my pet research topics.
Yes.
Um, so, so this is really an interesting area, I think. So, along with a colleague of mine, Anil Rao, who's appeared on this podcast sometimes, Anil and I have been looking at uh, first, why has the US market appeared to have done so well, or has done so well over the course of the 15 years or so since the financial crisis? Um, just a reminder to our listeners that up to the start of this year, the US market outperformed the rest of the world by about 7 percentage points per annum, right? And so that's why we find ourselves at this place where, at this point where US assets are kind of about 2/3 or more of global equity assets. So when we looked at this, we started asking, well, what types of companies have really underpinned this exceptionalism? And actually, what we found that valuations aside, there is definitely a group of companies in the US that has performed in a truly exceptional way over the past 15 years, and that is large and mega cap companies. And the when I say valuations aside, I mean that we can look at real world metrics of them and how they've evolved over the past 15 years, and we can see that they've really pulled apart from the pack. So, for example, US megacaps have more or less doubled sales per employee over the past 15 years, whereas the largest cap European stocks have actually gone modestly backwards on the same measure over time. R&D, pretty much all of the growth in, at least in developed market R&D over the last 15 years has come from US large cap stocks. Profitability has really expanded in US large cap stocks, whereas not really done anything different over recent times for other stocks. And most intriguing of all to us was one reason why value as an investment strategy has historically worked so well is that in general, we find that in general, it's kind of a stylized fact actually, that unusual company growth spurts don't last very long. If a company is growing fast at the moment or expected to grow fast over the next couple of years, very quickly they will revert to the mean of their peer group. And that has remained true over the period since 2009, except for these US large caps, where the half-life of an exceptional growth period has sort of doubled or more to 4 years or more.
Yeah.
So that's really this sort of price of growth story that we're getting, and we find that the market's prepared to pay for those long periods of growth.
Very, very interesting. And I love your opinion, Ashley, on, the US interest rate environment and how that might be supporting the paradigm you just outlined from the blog.
Yeah, well, this is fascinating.
I don't know if I'm switching channel.
No, that's all right. I think this is fascinating, right? I mean, this time 3 months ago, um, I was chatting with Axel, our colleague, and we were talking about kind of the interest rate outlook. And I said, well, I think we need to really keep an eye on a steepening of the yield curve in the States and whether the long run inflation expectations will become sort of unanchored. And therefore, even aside from what happens at the front end of the curve, maybe the long end of the curve will increase. And quite frankly, that hasn't happened at all. I mean, that call was totally wrong. So while the long end of the curve in other markets has continued to drift up a little, in the US, it's come down over the last quarter. Personally, I find this quite sort of amazing. Clearly, it must be beneficial for the valuation of these sorts of growth companies and perhaps also of private companies that we can come onto. But to me, this is an amazing fact in the face of, attacks on the Fed's independence, sacking the commissioner for the BLS, who's responsible for producing inflation statistics, and now a government shutdown in the US of indeterminate length. I'll tell you, I'm not quite sure how to read developments at the long end of the curve in the US. Do you have a take, or do our clients have a take?
I just think we're in a time of, as you mentioned, your words, unprecedented uncertainty. And it's a little bit of, a paralysis, I think, for our clients. And then there's a little bit of FOMO, right? Fear of missing out on this, perhaps unprecedented technology wave in and then looking through all of the dynamics you just described, and we have this, continued somewhat melt up of these markets. It's very interesting, and I think there is quite a bit of uncertainty, but a lack of inclination to dramatically change asset allocations.
Well, something you said earlier that I thought was super interesting was that clients were kind of keeping an eye on things and sort of sounded like they were ready to jump ship if they saw a catalyst to do so. And a phrase which I've been hearing more in the last 3 months than I have in quite a few years is that famous phrase by I think Prince, the CEO of Citigroup, during the financial crisis. And in comments afterwards, he said, "Well, while the music's playing, you've got to dance." Right? And he invoked this as an explanation of why, even though kind of a lot of people in the financial markets could see signs of trouble ahead in 2007, 2008, no one really was able to stop dancing. So I don't know what trouble's ahead, but that phrase has been popping up in conversations I've been having with institutional investors around the world. So that seems pretty amazing to me. The government shutdown, just for the record, we're recording on the 6th of October. Um,
Yeah.
uh, do we have any idea from our American clients, sort of whether that's disturbing anyone, whether we expect this to have a significant effect on the financial market outlook if it drags on?
I think it's still quite early days, Ashley. I think people are holding out hope. Perhaps this week we get continuing resolution, right, until the next inflection point. But I think at this juncture it's a little too early to tell. But the news cycle is clearly extremely short, so things can change on a dime, as you know so well. And I just wonder if we've been trained a bit in the knee jerk reaction. Going back to the earlier topic of the rally post the sell off of Liberation Day, are we just now programming ourselves that we'll work through some of these unprecedented situations? I wonder if that's also somewhat of a tailwind as well. But at this juncture, I think people again are perhaps still dancing despite even this latest inflection point.
The latest. Indeed. I mean, it's very striking on this side of the Atlantic. And so, I've sort of been pretty clear about kind of the causes I think that there are for bearishness about the course of U.S. institutions, at least compared to what has historically been thought of as a sound basis for long-run institutional governance. And so, in some sense, we're in the middle of a grand experiment here in policy making. And so none of us should write off the possibility that the set of institutions currently being put in place in the States might lead to all sorts of future flourishing. But traditionally, economists, and my training is as a growth economist, think that a high degree of predictability in policy making, that the impersonal application of the rule of law, the institutional separation, some degree of fiscal discipline. Historically, economists have thought those are growth-supporting institutions. Just on this fiscal point, that the U.S. is now in breach of what the Harvard historian, or I think now, Stanford historian, Neil Ferguson, has termed Ferguson's Law. Ferguson's Law, roughly speaking, says that if an empire spends more on debt service than it does or can on defense, then the empire is at imminent risk of decline. And that's the point that the US has got to, and with big fiscal deficits stretching out as far as the eye can see, and yet, as I say, this decline in interest rates. Now, compare that to this side of the Atlantic. Maybe one reason why investors don't react more strongly against the US, even in the fixed income markets, is that it's not like other places seem that much better. In particular, just today, France has seen the resignation of its prime minister, who's now the shortest-serving prime minister since the institution of the current French Republic in the 1950s. And so France is going sort of the full Italy with a new prime minister every other Tuesday. The rest of the continent is not looking too hot either fiscally. And so maybe that's yet another reason why it seems that markets are prepared to extend what seem like kind of extraordinary degrees of credit to the US.
Agreed, Ashley. And maybe I'm an eternal optimist, but maybe it's a great time to look at another major theme I mentioned earlier, which is AI. And of course, that was clearly a dominant theme in our recent investment summits, and certainly to take up a lot of oxygen at our upcoming asset owner forums globally. So I'd love to get your thoughts on that theme and how it's perhaps again helping to support the valuations, particularly in the U.S. and the Mag 7.
Well, there's no doubt that it is, right? That's definitely for sure. I mentioned PEs earlier of like 33 for US mega caps. Another sign of kind of extreme valuations is that the price earnings ratio of the tech sector globally is over 40. So investors are definitely really excited about AI. One interpretation of why investors may be prepared to extend this sort of benefit of the doubt to the US. There's basically two interpretations. One is that the US has maintained its so-called exorbitant privilege, that it's still the ultimate sort of safe haven and so on. But another interpretation is just that investors are very optimistic about AI, and in particular, investors believe And here, there's two sub-interpretations. Either investors believe that the US is going to drive all the AI gains in the sense of having the AI companies. But I think actually investors are making a stronger sort of statement as well, for the most part, which is that investors believe that the bulk of the early productivity gains, independent of sort of the AI stocks themselves, the bulk of the early productivity gains will also come from the States. Swings of just, say, half a percentage point in future productivity can, over the course of 15 or 20 years, add up to a 50% or so swing in the ratio of debt to GDP, that we can imagine sort of occurring out around 2050 or 2040. So exactly what we think AI's impact is going to be has a huge effect on our sort of long-run fiscal and therefore interest rate outlook.
Absolutely. And I think, probably from a client standpoint, what we're seeing is, a lot of our large clients, particularly in the asset management, but not solely asset management, are undergoing structured reevaluation of their data infrastructure to make sure it's AI ready. So we're seeing some of the largest. There's recent article around Vanguard, and what they're doing around their data infrastructure. And of course, we're having a lot of great conversations with clients about how we fit into those conversations. But that's one theme. And then, of course, downstream, how does that revolutionize the investment process? And again, bringing them a lot of cost savings, which, of course, in the asset management segment will be welcome. And then the third theme, which was brought up at our investment summit just 2 weeks ago in New York, is how does it change the way we develop talent, more junior talent in these organizations, if much of the sort of what we used to call grunt work or earning your stripes, much of that is tackled by AI. And so how do we adjust how we develop young and talented people, such that they still get the experience and are not getting lost in the shuffle, if you will. I think that's perhaps a continuing theme of what we saw perhaps through the pandemic, where there was clearly a lot of hiring, and we could do that easily, and people starting from home, but really losing that human touch, losing the oversight and being able to learn by seeing, sitting next to someone, whether it's selling or research or product development. So those are some of the themes that we're seeing from a client standpoint, if you will, from investment management to people management.
That's super interesting. I agree with you on all of those themes. Just picking up on kind of the first one about where we are in kind of the AI adoption curve. I think this is really interesting. There's been a certain amount of perhaps mild disappointment at times that has moved the market a bit about kind of how successful AI has been so far. There was that widely cited MIT paper that said 95% of AI projects aren't paying off or something. And that moved the market a bit on that day, and then the market promptly forgot about it and moved on. Yeah, I think that from what we're seeing from our clients, um, it takes time for big organizations to really figure out how to get moving on AI, how to really incorporate thinking about a brand new area systematically into their organizations. And kind of a classic case of this is just thinking that the new technology is going to enable us to do all the same things as the old technology did, about 50% faster and or cheaper or whatever. And really the key thing here is that AI is a general purpose technology, and general purpose technologies, that is things that are useful for a whole range of things, just don't work that way. Instead, what they do is they open up whole new vistas of ways of doing things which wouldn't economically have been feasible before. And so they render whole old organizational structures and even product type thinking redundant as we move to kind of, I'll use an overused word, but I think it's appropriate in this case, a new paradigm. So to give you an example, AI is still a very imperfect technology. In many cases, it's sort of, let's call it some arbitrary number, 80 or 90% accurate. But a lot of the products which people have built in the past have been very finely refined over time, such that the only acceptable degree of accuracy now is something close to 100, 99.9 or 99.99% accurate, right? Because we've been living in a relatively stable technological backdrop until now. And so if you introduce an 80 or 90% technology to a set of products that need 99.9, the economic value you produce is not much. But what we see is whole new vistas of where before you couldn't get any insight or information. And so getting to 80 or 90% is going to be revolutionary. An example of that is in work we're doing at the moment on supply chains, for instance, where we can bring in vast new data sets, hook them up, enable users to instantly undertake the sort of searches which previously would have taken sophisticated developers days or weeks to accomplish. But now anyone sitting at their desktop can do that in a fraction, literally in a fraction of a second. Of course, the information is still new and fresh, and so it won't be 99.9% accurate. But that's an example of where just looking to do the old stuff is the wrong thinking. Figuring out and imagining what the new stuff is what's really going to, I think, add value. And that goes to your point about talent development. I'm increasingly optimistic that we will be able to find stuff for even young people to do, because there's just going to be whole new fields of human endeavor that we're opening up here.
Absolutely, absolutely. And I also think that generation is likely not to carry, any baggage whatsoever, and really their glass is half full as far as, where AI can take us. I'd also comment that, on your comments around AI's capability on the data, and particularly on unstructured data that was there, but the ability to bring it together, synthesize it to actually allow us to make even better decisions around new themes, i.e. the climate transition. We don't have time for that theme today, but Laura Nishikawa, one of your lead researchers, obviously in ESG and climate, really made that poignant comment on the AI panel. So I thought that was, on point for sure and exciting.
Michelle, there's been a lot of excitement around the so-called democratization of private markets investing. We saw a flurry of kind of brand new types of products being released for retail investors. Of course, now private assets are even allowed into 401ks in the States, but this is a broader and global conversation. I'm just wondering, what are we seeing so far in terms of flows? Is there that there's definitely excitement from the industry. Is there excitement from the end investor?
Yeah, I think, we've seen, as you mentioned, a flurry of activity, a flurry of terrific collaborations announced, whether it's State Street and Apollo and Wellington Blackstone, Vanguard, BlackRock and Great Gray, as well as Voya and Blue Owl. We've seen a handful of products launched too. The flows, have been slow as they are in the beginning. And I think people need to get their arms around them. I think some of the initial products have reached about 100 million, which is not insignificant, but clearly, not extremely significant in terms of the assets out there.
When you consider that maybe only 5 or 10% of those products are actually in private assets.
Indeed. So I think a lot of education is still to be had. Reminds me a little bit of the flurry of product launches we saw when ESG was really gaining a ton of a momentum, driven by, the ability to customize and reflect investors' preferences in various products, and particularly ETFs. We saw a lot of product come to market, as well as in the mutual fund space. And there was a lot of confusion as far as like, how do I judge these, how do I evaluate these different products? which in some cases represented values, in some cases represented, the climate transition, and in some cases sort of integrated the both of those themes. I really think we're sort of at that stage that, we haven't seen the volume of products launched to that extent. Obviously, it's a much more complex problem, but there has been a lot. And, they're early days. There are still a lot of the products that I mentioned, the collaborations, the products that are still to come. So I think it's very early days. I think we need to, see more flows into these products and then have, the assets stressed, right, in perhaps a more volatile time. So a lot to come. A lot of education is needed. I think perhaps MSCI can play a big role in that. Would love your thoughts there.
I love that parallel on the sort of rush days of the ESG, because really, and the way you drew that out, because really what you're highlighting is sort of the question in those days was, what's the point? Are you looking for impact? Are you looking for return? Are you looking for some combination? And maybe, there's not only education, but also a sharpening of understanding of what purpose these assets serve in investor portfolios that's required. I was thinking about this yesterday, actually, and I thought, Michelle, well, let me tell you a story and see if you want to invest. So I've been hearing about this thing, like all the smart people have been making tons of money. If you're an insider, you're rich now. And the good news is, regular people like you and me are finally being allowed in. But if you want to know how much how much money the rich people have been making, actually, I can't quite tell you. Turns out that that's a bit of a secret between you and the person you invest with, and actually why that person's making a ton of money for you or how they do it. That's also a bit of a secret, and sometimes the story changes. And then when you get the money back, look, not quite sure, but trust me, you'll get it back. So anyway, so this investment class, I looked for some references, and they gave me that, and the references said, yeah, I've been pretty happy, but actually, funnily enough, haven't been getting much of my money back lately when I've asked.
Yeah.
So are you going to go all in with your 401k in that asset class? And kind of in some sense, that's a little bit the challenge that we're facing here in private assets. So I think we sort of need to face that if wealth investors or if potential retirees are going to put a lot of money in their asset class, the potential to pick up a bit of extra return is nice, but they need to understand what the characteristics of this asset class are. What's the evidence that it's outperformed? When can they get their money back and on what terms? All of this, what's actually generated kind of returns for this asset class, and therefore will it be replicated going forward? I want to know all the answers to those questions.
Yeah.
And in some ways, the industry is not set up, right?
No, and I think that's a great point, and I think it supports our work with a lot of GPs around delivering transparency, education, performance attribution of these types of products to that wealth end client. Because clearly, with the massive transfer of wealth that should be happening right now, they all want to harness that. But I think they are aware that it is, again, to use the paradigm again, a whole, it is a new paradigm, and it will require a lot more transparency to a point, education, and structure. Just how do I look at this in terms of my entire retirement plan, and what kinds of returns can I model and risk in turn. So we are doing a lot of work in that space. What we like to term is sales enablement, right, and bringing new opportunity sets. So it's opened up a great conversation and engagement channel with us and the GP client segment.
Now, I'll just, I can't help it. I'll just close by sort of saying a few things about returns in this segment. We just produced our second quarter report on private asset returns. The lag is because it takes GPs a long time to establish the value of their holdings, even retrospectively. And so it takes us almost a full quarter in order to figure out what was going on. But in Q2, all the major private asset classes recorded positive returns. That said, of course, private equities returns were rather lower, even than the returns of public equity in the US, let alone of some of these international or Chinese or mega cap stocks that we've been talking about. And that continues a run of a few years now. And at the same time, the amount of investments that are being realized, that is, private equity assets that are being sold and therefore the money can be returned to end investors, that continues to bounce along at kind of near record lows, maybe a little higher than Q1. And not that many new investments are being made, certainly well off the peak. And so this is an asset class which, or a set of asset classes, credit's holding up a bit better, but still maybe not taking off as much as might have been expected. A set of asset classes that we're going to continue to watch, and that, I think the world needs greater transparency on and understanding of in order to make important allocation decisions.
I think that's a great point to conclude on, and perhaps AI is going to help us and others bring more transparency faster to this asset class and to the ultimate end investor.
We do have some plans there, Michelle, but that's going to have to be another episode, I'm afraid.
We're teeing up the year-end episode here. What a pleasure to talk with you today, Ashley.
Thank you, Michelle. It was a great conversation.
That's all for this episode. Our thanks to Ashley and Michelle, and of course to all of you for listening, or in this case, perhaps watching. Remember, you can find more insights on the markets at our website at MSCI.com. And next up on the program, we'll continue exploring how investors are exploring themselves this evolving landscape. This time, with experts from Goldman Sachs Asset Management, as well as MSCI. They'll discuss a new index that's designed to bridge the gap between public and private markets. We hope you'll join us. And until then, I'm your host, Adam Bass, and this is MSCI Perspectives.